Hello everybody, welcome to this session on the emerging economic and market scenario. We have with us Dr. Vijayakumar, eminent economist and the Chief Investment Strategist of Geojit Financial Services. Thank you for joining us in this session, sir. The markets have turned very volatile in 2018 after a very stable run in 2017. Globally also we are seeing a lot of volatility in the markets. What are the reasons for this volatility, and do you expect this volatility to continue?
Yes, the markets were unusually stable and steady in 2017. In India also, every dip in the market was bought into. But that is not likely to be the scenario in 2018. Globally, the markets have turned volatile in 2018. In US history, 2017 was the year of the least volatility in US stock market history. But 2018 has already started with a lot of volatility in the market. In February, the Dow Jones crashed by more than 1,000 points twice, and that spread volatility to the rest of the markets also. The reason why we expect the markets to be very volatile in 2018 is the markets are priced to perfection. Globally, if you go by the parameters of valuation like the price to earning multiple, markets are priced to perfection. In India also, the valuations are now, if you go by the trailing PE multiple, markets are quoting at 25% premium to historical average valuations. So when we have such high valuations in the market, any trigger can cause a correction. The trigger can be an external trigger coming from outside, or it can be an internal trigger which happens from within. Either way, a correction is likely. But then there is a lot of money flowing into the markets, particularly through the mutual fund route. So corrections will be bought into also. So there is a very remote possibility of a major crash in the market. That's why we say 2018 is likely to be a year of high volatility.
There were a lot of triggers, external and internal triggers that, as you mentioned, that have affected this volatility. Can you please detail on these external and internal triggers?
Yes, actually markets will be impacted by unknown factors more than the known factors. But we can only explain the known factors. Externally, the known threads or the triggers for a big correction in the market can be either economic or geopolitical. The economic triggers can come from a more than expected rate hike by the American Central Bank Fed, or it can be the aggravation of a trade war between America and China, which started some time back, but it is subdued right now. Or the external trigger can come from worsening of the geopolitical situation anywhere in the world. The Middle East has again become a hot spot. We can't say what will happen in Syria or in Iran. Yesterday 55 people were killed in Palestine. So that will keep crude prices buoyant. All this can be major external triggers. But from the investment perspective, the most important factor that we should be looking out for should be the American Central Bank's monetary stance. Everyone knows that the US Central Bank is on a tightening cycle right now. There were 3 rate hikes in 2017, and the market expects 3 rate hikes again in 2018. But there is a possibility that the rate hikes might be even 4 or sometimes even 5 if inflation gets triggered more than expectations. So if the rate hikes by the Fed is more than what the market has discounted, there can be trouble for the markets, because that can be a trigger for capital outflows from emerging markets like India, because we are living in a world in which US dollar is the safest asset class in the world. So if the US bond yields rises, the 10-year bond yield rises to 3.5% for instance, now it is slightly less than 3%, then there will be capital flight from emerging markets to US dollars. So that is the most important factor that investors should be watching on. 3 rate hikes discounted by the market, that won't be a problem. But a 4th one or a 5th one, can rattle financial markets globally. The other factor, it was the factor that I referred to, that is the possibility of a trade war between US and China. That was a major concern about a month back, but now the indications are that US and China will reach some sort of an agreement, and that is what the markets have been, reason why the markets have been resilient. Coming to the internal triggers, well, there can be political and economic triggers. A very important factor, perhaps the most important factor impacting the markets in 2018 would be political. As we are speaking, the election results from Karnataka are coming, and that has already given a positive clue to the market. When I last looked at, Sensex was above, up by more than 400 points. Because the results have come as a shot in the arm for the BJP and the ruling NDA dispensation. The reason why politics is important is markets prefer certainty. Markets want certainty and stability in policy, and that will be there only if the present government continues. If we have a coalition government in 2019, a non-NDA coalition government, then the market expectation is that, market concern is that it is not likely to be a strong and stable government, and policy and reforms will be impacted. And it is feared that towards the end of this year, we have crucial elections. Actually, more than Karnataka, the elections coming up towards the end of this year in Chhattisgarh, in Madhya Pradesh and Rajasthan, where BJP is ruling. So the anti-incumbency factor is stronger there. So these are all grounds for possible corrections in the market. But if the political trend, actually markets will start discounting the political trend much earlier than the clear trends emerge. So these factors will keep the markets in tender hooks. But one thing is for sure, there will be external triggers, there will be internal triggers, unlike in 2017. And these corrections will be almost inevitable. You can anticipate corrections for sure.
So would you suggest to buy into these corrections, or should the investors adopt a wait and watch policy for this?
Well, what should be the investor response towards these corrections should depend on the nature of the correction. Suppose because of some major global trigger, like inflation in the US shooting above the Fed's comfort zone, or some unknown factor. Suppose there is a major correction, let us say a correction of more than 10% in Nifty or 15% in the headline indices. You can't rule it out, it can happen. If that happens, that would be a very good buying opportunity where investors can seize the opportunity and invest. But if the corrections are short and shallow, investors should not rush in and invest a big amount of money because with short corrections the market will not be very attractively valued. A 10% or 15% correction will make the markets attractively valued. So that will be providing the opportunity for big investments. So otherwise investors should be careful. The reason why I say that a big correction would be a buying opportunity is that there are very clear signs of economic revival in India. We know the demonetization and GST implementation temporarily impacted India's economic growth, but then in 2018-19, this financial year, India is likely to be the fastest growing large economy in the world. This is not what the government of India says. IMF projections, ADB projections, World Bank projections, all project India as the fastest growing large economy in the world in 18-19. That means India will be regaining its status as the fastest growing economy. And we know during the last 3 to 4 years, corporate earnings have been tepid. It has been very, very poor. And we have now reached a situation where there is every possibility for an uptick in the corporate earnings cycle. There's a very important ratio from the investor perspective, from the investment perspective, and that is the ratio of corporate earnings to GDP. The average in India, if you take the last 15 years, has been around 5.6%. It touched a peak of 7% in 2007, at the peak of the economic boom. Now it is around 4%. So from 4% corporate earnings to GDP ratio, if we move up the cycle and reach 5.25, we are going to witness an explosion in corporate earnings in the coming years. Maybe a 16 to 18% earnings growth this year is the consensus earning estimates. And the next year, 1920, we can even experience a 20% uptick in earnings. And therefore, the market is poised for a continuation of the bull run. Need not be in 2018 because of the political factors and triggers that we mentioned earlier, but in 2019. So, investors should be optimistic. The correction is sharp and steep. They can make bulk investments. Otherwise, they should be making systematic investments. That should be the ideal investment strategy.
So in your viewpoint, what should be the ideal investment strategy for retail investors in 2018?
In 2018, investors should expect only modest returns, because last year we had excellent returns from the markets. This year we should be prepared to accept only modest returns, and therefore you should have a conservative approach towards investments in 2018. We should understand a very important trend that is happening in the financial system right now in India. This trend that I am referring to is the financialization of savings, and within the financialization of savings there is a very big transition happening in favor of mutual funds and equity. So this is likely to sustain flows into the markets. Presently we have 2.2 crore SIPs and with very good growth. Last financial year, the mutual fund industry saw 2.72 lakh crores of inflows into the market. The reason why this is happening is that the other asset classes are becoming relatively unattractive. And this is a structural shift that is happening. It is likely to remain so for an extended period of time. So this will continue to channelize money into the market, and this is the reason why, in spite of poor earnings growth during the last 2 to 3 years, the markets have been very resilient. Even this year, the markets have been very resilient because of this inflows. So we can expect the market to remain buoyant. In fact, personally, I have been a little bit surprised by the resilience of the market during the last 1 month or so, because there are some economic headwinds also going against the market. For instance, now crude is $78 a barrel. At $78, well, we will trigger our twin deficit problem of fiscal deficit and current account deficit. This year we are likely to finish the financial year with a current account deficit of around 2.3, 2.4%, if not more. That kind of current account deficit will aggravate inflation, and inflation starts rising, RBI will turn hawkish, perhaps in the June monetary policy itself. All these are headwinds, but the market is not bothered about these potential headwinds because of this money flows. 7,500 crores is coming to the markets through the SIP route alone. So that is stable money, sticky money. It is not a fair weather money. Therefore, what investors should do is they should keep the faith, they should remain optimistic, but then the ideal investment strategy should be to invest big amounts only in big market dips. That will provide great opportunities to invest. Otherwise, continue with a conservative investment strategy. I would advise investors to give preference to large caps over mid and small caps, because in large caps valuations are better, and also the margin of safety is higher in large caps compared to mid and small caps. In many mid and small caps, valuations are very difficult to justify. Some are even in bubble territory. So investors who are very keen on investing in small and mid caps should invest through the mutual fund route, not directly, because identifying potential winners in small caps is a very difficult thing. Many investors lose money chasing multi-baggers in small caps. So ideally they should be investing through the mutual fund route in the case of small and mid caps. Large caps, when the prices correct, they can always buy. And the preference should be for the systematic investment plan. So the message is very simple. Expect modest returns for 2018. Be conservative in the expectations in 2018. You can be optimistic for 2019 and beyond. Don't make bulk investments on small corrections. Calibrate your investment over a period of time. Choose the systematic option route. Very important message, don't stop SIPs. One big mistake which retail investors commit is when a big correction happens or something unexpected happens, or when the markets are rattled, they panic and leave the market. That is the wrong thing to do. So investors should never stop their SIPs. SIPs should be continued, and the systematic investment in 2018 will reap rich rewards in 2019 and beyond.
So what we can understand from this session with Dr. Vijayakumar is that after a stable run in 2017, we can expect a little bit of volatility in 2018, little bit of corrections. These corrections, if they are huge, if there are deep corrections, the investors can buy into those corrections. But other than that, the ideal investment strategy for the investors to follow would be the systematic way of investments, take advantage of the volatility in the market. Thank you, Dr. Vijayakumar, for your insights on the emerging economic and market scenario.
Thank you. It was a pleasure talking to you.